Now, the last two parts of the B part of this problem, in those two scenarios now, we have one scenario where indeed you sell the asset for exactly book value. So the book value is $23,200 and you sell the asset for $23,200. That's the only scenario where there's no tax implications. There would be zero gain on the asset according to the IRS and no taxes owed. So how do you sell an asset so that there's no taxes owed? Well, you sell it for book value. Now, there's no such thing as a 100% tax rate. You always want to sell your assets for as much money as you can. But nonetheless, if you do sell for book value, there's no tax consequence. The other scenario shows us what happens if you sell an asset for less than book value. Now, in that scenario now, we sold for $15,000, an asset that had a book value of $23,200. In essence, the IRS is going to say that you didn't depreciate the asset enough, okay? And you're going to be able to write that loss off, and whatever the tax rate is on that, it's going to end up with being a tax savings. Now, again, you sold it for $15,000, would have had a book value of $23,200. It gives you a loss on the sale now of $8,200. Multiply that by the marginal tax rate, which they tell us is 40%. And that gives us a negative $3,280. What's a negative tax? That's a refund. That's a tax savings in this case. That's, all things being equal, that's good. It didn't get us back the whole loss, that we had on the sale, but it minimized the loss. And basically the IRS is saying, you should have depreciated the asset more. And if you had, then in the past somewhere, you would have saved another $3,280 because of the depreciation expense. But these are the last two scenarios in this problem. One, you're selling it for exactly book value. The other, you're selling it at a loss.